The 7 money mistakes that are silently eating your wealth. Good morning, investors. Today I want to talk about something that most financial educators avoid. Not what to do with your money, but what not to do. Because in my experience, wealth is not just built by good decisions, it is also destroyed slowly, silently, by a handful of very common mistakes that almost every investor makes at some point. Let me walk you through 7 of them. Be honest with yourself as I go through each one. Mistake number 1: chasing last year's top fund. Every January, newspapers publish the best performing funds of the previous year. And every January, thousands of investors rush to put their money in those funds. Last year's best performer is rarely next year's best performer. Markets rotate, sectors go in and out of favor. The fund that gave 45% last year may give you 8% this year, or even negative returns. Invest based on your goal and time horizon, not based on a chart that is already history. Mistake number 2: stopping your SIP when markets fall. This is the single most expensive mistake I see, and almost everyone makes it at least once. When markets fall, your SIP is actually buying more units at lower prices. It is like your favorite brand of biscuit going on sale. You should buy more, not less. But instead, most investors panic and stop. Please, whatever happens in the market, keep your SIP running. Mistake number 3: keeping everything in fixed deposits. FDs feel safe, I understand, but here is the reality. At 6.5% interest, after paying income tax, your real return may be 4% or less. With inflation at 6%, your money is actually losing purchasing power every single year. FDs have their place for short-term goals and emergency funds, but your entire life savings cannot live in an FD and expect to grow. Mistake number 4: ignoring inflation. We will cover this in detail in a separate tip, but let me give you one number today. What 50,000 rupees bought in 2010 costs 1 lakh rupees today. If your investments have not doubled in 15 years, your real wealth has shrunk, even if the number looks bigger. Mistake number 5: no nomination, no will. We covered this in tips 16 and 17, but I will say it again because it is that important. You spend decades building your wealth. Without a will and updated nominations, your family may spend years in courts trying to access it. Please, this week, update your nominations and speak to a lawyer about your will. Mistake number 6: never reviewing your portfolio. Investing and forgetting is not the same as staying invested. A fund that was excellent 5 years ago may be consistently underperforming today. One review per year, just 1 hour with your distributor, can make a significant difference to your long-term returns. Mistake number 7: too many funds. I have met investors with 22 different mutual fund schemes. They think more funds means more diversification. It does not. It means more confusion, more overlap, and no clarity on what is doing what. 5 good funds across different categories is more than enough for most families. Keep it simple. The real lesson: none of these mistakes require great intelligence to avoid. They just require awareness and a little discipline. You do not need to do everything perfectly. You just need to stop doing these 7 things wrong. My WealthWise spin-up rule for today: wealth is built by good decisions. It is protected by avoiding bad ones. Now I want you to be honest with me. Which of these 7 mistakes have you made or seen someone close to you make? Drop it in the comments. No judgment. We have all been there. I am MV Suresh, founder MV Suresh WealthWise. For regular mutual fund updates, connect with me on Facebook, Instagram, LinkedIn, YouTube, and Telegram. Wishing you good financial health. I'll be back tomorrow with a new tip. Till then, stay wealthwise.